Tonight at our house, we're having a fundraiser for the school that Burgess and I founded. Really, Burgess founded it. And we just completed, or it just completed its second year, which is pretty amazing, kind of against all odds. Starting a public charter school in any town or community or county is difficult. But we did it, and we have brought social emotional learning and project-based learning to 250 kids, though some of them probably could have afforded private school, like our son. The majority of them could not. And so bringing kind of first-class education to kids whose parents make $20,000, $30,000 a year in Silicon Valley was no easy feat. So tonight we're having our fundraiser here at our house. The last one we had was 2 years ago. So we're getting ready for that. People are outside setting up tables, and it should be a warm evening. So good to have you all here. As a reminder, what we do with these podcasts is we look at price. And the reason we look at price is because out of all the things we can look at, out of all the things humans can study when it comes to the stock market, the one that has the least amount of wiggle room or lies or biases is price. Price doesn't lie. You can't have a CFO of a company give you the pro forma price or the forward-looking price or the operating price or the trailing price. There's only one price. Ask 10,000 people what Microsoft closed at today, and you're going to get the same answer, assuming they all know how to go online and search for what's the closing price of Microsoft. But you ask someone what the value of Microsoft is or what it's worth, and that's a very different question. So with studying price, we're able to cut through an incredible amount of the noise and deception and manipulation and be able to look at what is the signal, what is the direction, what do we need to know, what's most important about Microsoft or the stock market or the 10-year Treasury Yield in Germany or Japan or the US or Australia. Price charts can give us a lot of information about that. And so I go through, and by the end of the week, I literally sit down and think, okay, what was the most important price chart? What was the most important piece of news that perhaps you should take a look at? And sometimes it's really hard because there's just nothing going on. I mean, yeah, I can talk about how the German bond is going up and the U.S. yields are spiking over the last 6 weeks. And, and sometimes I do. It's kind of fun to kind of dig into the daily prices and intraday and sometimes weekly. But we're going to do something slightly different today to give us that, we'll call it the big picture view. Hey, everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend is really step back, really take a big step back and let's just see what's going on. Because sometimes, I think taking that big step back and looking at a nice kind of big picture price chart can really help us get a view of what is going on. And it really helps us eliminate just a lot of the emotion. And the way I think about this is when you're in traffic heading somewhere, especially if you're late, it's a very emotional experience. You can't see around the curve or a mile ahead. All you can see is all the cars in front of you, and they're not going fast enough. Now, the funny thing is you are part of that traffic, but we never recognize ourselves as being part of it. It's just all the other cars that are creating us problems. But if you're in a helicopter a mile up looking down, you could probably see, yeah, it's going slow, but they're going to get there. And so that's what I want to do. I want to have us kind of think about this like we're in a helicopter looking down and kind of noticing what we're noticing without emotion, because there's much less emotion about a traffic jam when you're not in it. Now, the first price chart I want to show you, and there's only 3 price charts I want to show you, really zoomed out, is the S&P 500. And this price chart goes back to beginning of 1995. So we have a good amount of data on here, about 20 years. And you can see the peak in 2000, and then you can see the peak in 2007. And now where we are today is we're about 62% above the last two peaks. 62%. Now it's actually 61.8. We're within, tenths of a point or hundredths of a percentage point. Now the reason why 61.8% is interesting is because that is a Fibonacci ratio. 38%, 50%, 62%, those are Fibonacci ratios, and we are 62% above the last two peaks. The other thing that's just kind of fun, more fun than anything else, is the distance between the first peak in 2000 and the second peak in 2008. It was 7 years and 7 months. Today, from this peak to this peak, it's 7 years and 7 months. Not saying there's any weight to that time frame, but it's just kind of interesting that here we are at another major kind of potential turning point, pausing point. But big picture, the market's going up. Even since 1995, the market's gone up with two huge, incredibly painful 50% corrections. And if we were to zoom way, way out, say 50 years or 100 years, you and I would both notice that, yeah, you know what? It does go up over time. And on average, it does go up 9.5% over time, but very unevenly. What actually the S&P does is it goes up about 18 to 20% compounded annually a year for about 18 years. And then the other 18 years, it goes up about 4% a year. And when you average that out, you get your 9.5%. And so right now, since the year 2000, we're in one of those painful 18-year cycles where the market's going up, the S&P's going up about 4 or 5% a year. But again, in a very, very kind of scary, dangerous, choppy way. But the takeaway, market's going up, has been going up since the beginning of 2009, and we're at a decision point. Does this market move higher? If so, that's very, very strong strength. And does it correct? In fact, even if it corrected down to 1550 and lost 600 points, we'd still be above these old two major kind of ceilings, and it would kind of sit on that. And it's very likely that when we do have the next correction, that we will see probably a 600 point correction, which, all things being equal, will be very painful, but it won't be the end. And that's right there. That's about a 30% correction. The next price chart I want to show you is the yield on the 10-year Treasury note. This goes back to 95 also. And if you look at the screen, you can tell that from 2006 to today, the yield's been in a pretty steep falling trend. A lot of volatility. I mean, from the beginning of 2011 to the middle of 2012, the 10-year Treasury yield went from 3.5% to 1.3%. That is incredible. I mean, that move is just astonishing how fast it moved down and then almost equally moved up as fast. So we are still in a downtrend, or the 10-year yield is still in a downtrend, and just an incredible amount of volatility that's going on within the 10-year Treasury. What's going to happen next? I don't know. Is it going to bounce off the 2.5%? Is it going to go up to 3% again like it did at the end of 2013 and then reverse back down? Here's the big takeaway. We don't need to entertain the value, or you don't need, or no one needs to entertain the value that we're going to have hyperinflation and inflation's getting away from us. And until really the 10-year Treasury gets above 3% and stays above. Until that happens, that's kind of our signal for, is there inflation coming? Maybe not hyperinflation, but is inflation coming? Did yields really bottom past tense? And we'll get that answer when, not if, we don't know when the 10-year yield breaks above 3% and stays above it. Then we can say, okay, the bottom has put in, with very high probability, we can say the bottom has been put in, but right now we don't. And it's very likely if the S&P is at this major resistance point, being 61.8% above the last two major market tops, and the market does correct 10 or 15%, not even that 30% that I was talking about, but just 10%, it's very likely people will flood into bonds, which will have the price go up and the yield go down. So in some ways, we kind of have to wait for the next market correction to see what bond yields do. and we have not had really any noticeable correction in the markets for many years. The last price chart I want to show you is a price chart of gold, looking again back to 1995, beginning of 1995. You look at this thing and you go, whether you're looking at, the bottom in 99 or the bottom in 2001, it bottomed at $250, gold did. And then it went all the way up. And you're looking at a monthly chart, meaning each point on here is the closing price of the month that we're looking at. So it doesn't show intra-month high or intra-month low. It's just showing, hey, what did gold close at for every month going back to 1995? And I just want to put on top of here a Fibonacci retracement ratio showing the move from down here to $250 all the way up to, again, the close of the month was $1,830. Even though gold hit $1,920 intra-month in September of 2000, it closed that month at $1,830. So within looking at kind of minimal data, which I don't want that to sound minimalist, but more like straightforward, simple, clean up a lot of information. We've had a correction past the 38%, 38.2% Fibonacci ratio correction. So it's stuck around there. Looks like it's moving a little low and wants to get to the 50% correction, which would take gold to about 1040, which means if it's at 1040, it's going to hit 999. It's just too much of an emotional pull to that price. So this is why I say gold is still in a long-term uptrend, because all it is doing is making a very healthy Fibonacci correction within a much larger uptrend. But right now, I don't suggest being in gold and silver, specifically because the counter trend, though it is getting closer and closer to its 4-year mark, for gold it'll be September. For silver, we've already passed it, and we're into its 4th year. Now into, I believe, the 49th month for silver falling. But we're in a counter trend right now to the major uptrend. And until that shifts and changes, it's actually safer to step aside from gold. So the question is, what's the takeaway? Really, the biggest takeaway I want you to get, and I fail at this sometimes. You hear me sometimes getting into like the nitty gritty of intraday. Actually, I almost never do intraday in these weekend podcasts, but I do talk about daily. I do talk about weekly. And, sometimes I really struggle, like, what should I talk about? There's just not much going on. There's a lot that can be going on. There's definitely stuff I can talk about with the S&P 500 potentially at a turning point, and the German stock market potentially at a turning point, and hundreds of billions of dollars that will be flowing into China over the next couple years. That is definitely newsworthy. And China wanting to be a reserve currency of the world. But really, when we kind of zoom out and take a big step back, we can eliminate a lot of that and just wait for the price to tell us what's actually happening. So kind of the takeaway is, do your best to keep it simple. I mean, we as humans suck at investing. We were not designed to invest. We were designed to survive the thing with big teeth running at us. So in keeping it simple, let's just keep it simple with these 3 indices that we looked at. And the S&P, it's going up right now. It's boring. There's not much to talk about. It's been boring the entire year. Yes, it's at a major potential turning point, but right now it's just boring. But it is going up. The 10-year yield, it's been falling for 34 years. If June of 2012 was in fact the bottom, we will know that looking back. I'd like to see one more correction in the stock market to see what happens in bond yields. But right now, the 10-year yield is still big 20-year trend. It's still trending down, and until the 10-year yield breaks above 3% and stays above it, we are still in the major down cycle or downtrend of yields. And then lastly, gold. It's still going up, but we're in a correction. In that kind of the big picture, yes, it's going up, and we are in a counter trend correction. Or maybe that's being redundant. A correction. And yes, it sucks to be in a correction and wait for it to end. But there is a lot of force behind gold wanting to go higher. And though it has surprised me that this correction, again, silver's in a 4-year plus correction, Gold's in a 3.5, a little bit more than a 3.5 year correction. Surprised me the length of it, but that's just what's happening right now. We will get back in, but right now gold is big picture going up, but we're within that correction period. So we're going to wait until that correction period finishes. And there's 3 very specific signals that I watch for and look for that will, from a probability point of view and a historic point of view, tell us this is the time to get in. And right now, all 3 of those are saying, nope, not right now. Hey guys, thank you for being here. This is just another step in helping you protect your portfolio and protect your future. Until next time, this is RC Peck. Hey guys, thank you so much. Little reminder, probably one of the best things you can ever do is have kind of an outside set of eyes look at what you're doing with your investing, with your portfolio, with your net worth. We all, at some level, want to do what's best for our money, but to kind of have that third party set of eyes look at your portfolio, look at your strategies, look at your investment symbols and say, and really look and go, okay, where is the drag coming from? Where are the accelerants coming from? What can you do? Some small things you can do to grow your money more effectively, more safely. And one of the things that I've done for my clients for years and people in my world for years is do what I call a strategy review and a portfolio x-ray. And in that, we get to speak on the phone and I get to put my entire attention on your money and what it is and is not doing. That may be something you're getting close to wanting to do, if not already. And when you are, it's really simple. You just reach out to Patty, Patty, at Fearless Wealth, though even if you spelled her name differently, it would still get there. And just talk to her saying, hey, I want to get one of those strategy sessions set up with RC. And it's really straightforward. All right, guys, you have a great weekend.